Welcome back, everyone, to another deep dive. This time, we're going to be looking at something that's a little bit different than our usual stock picks. We're diving into bond ETFs.
Oh, yeah, bonds. Always an exciting topic, right?
Well, maybe not quite as exciting as, like, the latest tech IPO, but definitely important, especially in today's market. So we're specifically looking at the iShares 20-plus year Treasury bond BuyWrite strategy ETF.
That's a mouthful.
Yeah, tell me about it. We'll just call it TLTW for short.
Much better.
To help us figure this thing out, we've got a whole stack of analyst reports, financial data, and some fresh opinions from some experts.
Sounds like a good mix.
So the big question for this deep dive is, should you be looking at TLTW?
That's what we're here to find out.
And how does it compare to just holding a plain old long-term treasury bond ETF?
Right.
Like something like TLT?
Yeah, the classic choice. Right.
Exactly. So we'll unpack all of that and try to arm you with the insights you need to make an informed decision. Ready to dive in?
Let's do it.
Okay, great. So first things first, what exactly is TLTW?
Well, at its core, it holds long-term U.S. Treasury bonds, just like TLT.
Okay, so far so good.
But there's a twist.
There's always a twist.
The BuyWrite part is where things get a little more interesting. TLTW sells covered call options on those bonds. It does this every single month.
Covered calls. I always hear those two words and my brain just kind of shuts off. Can you break that down for me and for our listeners who might not be options experts?
So, the thing, it's actually simpler than it sounds. Imagine you own these bonds, right? With a covered call, you're basically saying, I bet the price of this bond won't go above this specific price.
Okay.
And in exchange for making that bet and taking on that risk, you get paid a premium.
So if the bond price stays below that level, TLTW pockets that premium and that kind of boosts their overall income.
Exactly. They're aiming for that extra income.
But what if the bond price goes way up? Does TLTW miss out on some of those gains?
That's the trade-off. They might sacrifice some of that potential upside. So yeah, it could go either way. And that's why TLTW behaves differently than just holding TLT.
Gotcha. So how has TLTW actually been performing? Give us the numbers.
Well, year to date, as of January 8th, 2025, it's down 1.36%. Not exactly setting the world on fire.
Not great. But how's it doing compared to TLT?
That's the thing. It has actually outperformed TLT, which is down 4.4% over the same period.
So even though the market's down, that options strategy is working in TLTW's favor?
Seems to be. And if we zoom out and look, since TLTW's inception back in August of 2022 through December of 2024, it's down 5.97%. Again, it outperformed TLT, which declined by 5.98% over that same time frame.
Okay, so it's consistently doing a little bit better than just holding TLT.
Yeah, but there's a caveat here. We have to keep in mind this has been a rough period for bonds in general.
Right. Context is everything. So let's talk about why TLTW is maybe so interesting right now. Our analyst seems to think there's something special happening in early 2025.
The analyst is drawing some parallels between the current market and the late 1990s. That was a period where we saw something called a soft landing. The economy kind of cooled down, but it didn't completely crash into a recession.
Okay, an economic history lesson. Always fun. But how does that tie back into TLTW?
One of the key similarities is the yield curve. That's the difference between short-term and long-term interest rates.
The yield curve. Always a favorite topic for market watchers.
Right. It's a big deal. And just like in the late 90s, the yield curve right now is pretty flat.
Okay. And back then, this type of environment tended to be pretty good for bonds.
That's the idea.
Right.
Because bond prices were relatively stable.
And stable bond prices are what TLTW needs for its covered call strategy to really shine.
Exactly. Less volatility equals a higher chance of collecting those option premiums without the bond price going above that strike price of the calls.
Okay. I'm starting to see why the analyst is so intrigued by all of this. But hold on a second. Is a soft landing a guarantee? It doesn't seem like the Fed is even convinced that's where we're headed.
Yeah, there's definitely some debate going on. The Fed isn't totally sure what's going to happen next. Actually, they've even started cutting interest rates recently.
But didn't they just spend like the last year or so aggressively hiking rates? It seems like they're sending some mixed signals here.
It does seem that way. They kicked things off with a massive 50 basis point cut back in September 2024.
Which was a pretty unusual move, right?
Very unusual. And it could be a sign that they're more worried than they're letting on.
Interesting.
And here's another thing. Market volatility seems to be playing a role in the Fed's decision-making, specifically the VIX.
For our listeners who might not know, the VIX is basically an index of expected market volatility, When it goes up, it usually means investors are getting nervous.
Yeah, and that can definitely push the Fed to act. So it seems like they might be more sensitive to all the market jitters than they'd like to admit.
Okay, so we've got a lot of factors at play here, but let's bring it back to TLTW. What does all this Fed uncertainty and talk of soft landings and market anxiety actually mean for this specific ETF?
What we've been talking about, covered calls, work best when that underlying asset trades sideways.
Right, so in this case, TLT?
Exactly. The analyst thinks that this flat yield curve is a good sign that bond prices are going to be more stable, which would be the ideal situation for TLTW to just keep raking in those option premiums.
That makes sense, but we have to talk about the risks.
Well, absolutely. There are always risks. One of the biggest ones here is a surprise jump in inflation.
Uh-oh.
Yeah, if that happens, the Fed might have to go back to hiking rates, and that would be bad news for TLTW.
Because higher rates usually mean lower bond prices.
Right, and those covered calls might not be enough to make up for a big drop in the underlying bond value.
So that whole idea of the market staying nice and stable could just disappear overnight.
Pretty much. And then
Yeah.
there's another risk we need to consider,
Oh, there's more.
a recession.
But I thought lower rates were good for bonds. Wouldn't the Fed cutting rates during a recession actually help TLTW?
It seems logical, but it doesn't always work out that way. Even if the Fed cuts rates, long-term bonds might not rally as much as you'd expect during a recession.
Because of that flight to safety we talked about earlier, with investors moving into short-term treasuries.
During a recession, investors get really scared, and they tend to pile into the shortest-term, most liquid Treasury bonds because those are seen as the safest.
So even if longer-term rates fall, the demand just isn't there to offset all the negative sentiment.
Exactly. And in that kind of environment, TLTW's covered call strategy would probably underperform because those calls would limit its ability to participate in any potential upside while still exposing it to all the downside risk.
Okay, so it sounds like TLTW has been pretty resilient in this recent bond market slump, but its future performance hinges on a lot of factors that are still really uncertain.
That's the investing game for you, always dealing with uncertainty. But the more we understand how TLTW works and what its potential benefits and vulnerabilities are, the better decisions we can make. Decisions that fit our own risk tolerance and our investment goals.
Very true. So we've covered a lot of ground already. We've talked about covered calls, the yield curve, the Fed, a potential soft landing. Before we move on, though, let's shift gears and look at how TLTW has actually performed since it launched. We'll dive into those details in part 2.
All right, so we've talked about how TLTW works, right? It's essentially a bet on those long-term U.S. Treasury bonds kind of just trading sideways.
Right, a bet that they're not going to suddenly shoot up in price or crash down.
Exactly. So now let's actually look at the numbers and see how that strategy has played out since this fund launched back in 2022.
Let's do it.
Okay, so we've got some charts here that show TLTW's performance since August 2022. And we're looking at it both with and without dividends reinvested just to give us the full picture. What's the first thing that jumps out at you?
Well, the first thing I see is red. Red like negative returns.
Yeah, it hasn't exactly been a smooth ride. As of January 11th, 2025, it's showing a total return of negative 5.79% with dividends reinvested and negative 5.02% without.
So not exactly a home run. But like we said earlier, we have to remember it's been a pretty tough time for bonds in general.
Exactly. It's all about context. That's why we always got to compare TLTW to its benchmark, which is that plain vanilla TLT.
Right, because TLTW is designed to generate that extra income through the covered call strategy, but it might lag behind if TLT suddenly takes off.
Exactly. So let's see how they stack up.
Sure.
Over that same period, TLT has posted a total return of negative 7.31% with dividends reinvested and negative 7.08% without.
So they're both in the red, but TLTW is actually doing a bit better.
A bit better, yeah.
Yeah.
It seems like that covered call strategy is providing a bit of a cushion during this downturn.
Okay, so those option premiums are doing their job, adding that little bit of extra income on top of the regular bond distributions.
It's doing what it's supposed to. But let's not forget about those risks we talked about, that inflation risk
Yeah.
and the possibility of a recession. How could those things affect TLTW's performance going forward?
Yeah, that's the million-dollar question.
So if we see a sudden spike in inflation, that would be a major problem. If the Fed is forced to hike rates aggressively, bond prices would probably tank.
And TLTW wouldn't be immune to that?
Nope. those covered calls wouldn't be enough to offset a big decline in the underlying bond values?
Right. It's like that Goldilocks scenario we were talking about. The market has to stay kind of just right for this strategy to work.
Exactly.
Okay, what about a recession? We touched on this earlier, but I want to make sure I understand. If the Fed cuts rates during a recession, wouldn't that be good for bonds and for TLTW?
You'd think so, right? But it's not always that straightforward. Even if the Fed cuts rates, long-term bonds might not rally as much as you'd expect during a recession.
Because of that whole flight to safety thing, where investors move into short-term treasuries.
Exactly. It's like investors get spooked and they run to what they perceive as the safest assets, which are those short-term, super liquid treasury bonds.
So even though longer-term rates might be falling, the demand for those bonds just isn't strong enough to like balance things out.
Yeah. That's the gist of it. And that kind of environment is where TLTW's covered call strategy would probably struggle, because those calls would limit its ability to participate in any upside while still exposing it to that downside risk.
So it sounds like TLTW has been holding its own so far, but there are a lot of what-ifs that could really shake things up.
There are always what-ifs in investing, but by understanding the mechanics of this ETF and what those potential benefits and vulnerabilities are, we can at least make more informed decisions that make sense for our own risk tolerance and our own investment goals.
Well said. We've looked at the numbers, but that comparison to the late 1990s that our analyst made is still kind of bugging me.
Oh, yeah.
Like on the surface, it does seem like the current market has some things in common with that period.
It does.
We've got the flat yield curve, the economy is slowing down, and the Fed is sending mixed signals. But is it really a valid comparison? Or are there some key differences that investors need to consider? Let's explore all of that in part 3. All right, so we've dug into how TLTW works, we've looked at its performance, we've talked about some of the risks involved, but now let's circle back to that comparison our analyst made to the late 1990s. Is it really a valid analogy, or are there some crucial differences investors should be thinking about?
That's the big question, isn't it? We always have to be careful about making those historical comparisons.
Right, because things are never exactly the same.
Exactly. So on the surface, yeah, there are some similarities between today's market and the late 90s. Like we talked about, we've got a pretty flat yield curve. The economy seems to be cooling down a bit, and the Fed is sending some mixed signals. But we can't just assume that history is going to repeat itself. We need to look deeper.
So where do we start?
Well, let's start with that yield curve.
Right, back to the yield curve.
A flat or even a slightly inverted yield curve basically tells us that the market thinks monetary policy is kind of in a neutral zone. And that was definitely the case for a lot of the late 90s. Alan Greenspan was at the helm of the Fed back then, and they were making these small tweaks to interest rates.
They were trying to find that sweet spot.
Yeah, they were walking a tightrope, trying to keep inflation under control without completely killing economic growth.
And it seems like the Fed is trying to do something similar today with these smaller rate moves and all this talk about being data dependent.
Right, but there's a big difference between now and then.
What's that?
The sheer size of the recent rate hiking cycle. It was way more aggressive than anything we saw in the 90s.
The Fed took rates from like near 0 to over 4% in a really short amount of time.
And that created some serious shockwaves in the economy and the market.
No.
So even though the yield curve might look similar on paper, the forces driving it are completely different.
It's not an apples to apples comparison.
Exactly.
Okay, so that's one strike against the late 90s analogy. What else is different?
Inflation.
Ah, yes. The word that everyone's been talking about for the last couple of years.
Inflation was pretty tame in the late 90s. It was hovering around 2%. But today, it's significantly higher, even though it's come down from its peak. And that makes the Fed's job way harder.
They can't just sit back and relax like maybe Greenspan could back then.
Nope. Yeah, they have to be much more vigilant because the risk of inflation spiking again is much higher now, which means they might have to slam on the brakes and hike rates again if they see prices getting out of control. And that could create a lot more volatility in the bond market, which wouldn't be good for TLTW's covered call strategy.
Okay, so we've got two strikes against the late 90s analogy.
Two strikes.
Anything else investors should be aware of?
Debt.
Debt, like government debt, corporate debt.
Both. The overall level of debt in the economy is way higher now than it was in the late 90s. And that means the economy is much more sensitive to interest rate changes. It also means the Fed has less room to maneuver.
So even if they want to be gradual and data dependent, they might be forced to act more aggressively if those debt levels start to become a problem.
That's a real possibility. And that could spell trouble for bonds, especially longer-term bonds, like the ones TLTW holds.
Okay, so maybe the late 90s isn't the perfect comparison after all.
It's not a perfect analogy.
So what does all of this mean for investors who are considering TLTW?
It means they need to be extra cautious and do their homework. Don't just assume that history is going to repeat itself. Really think about those key differences we talked about. The scale of the recent rate hikes, the current level of inflation, and the huge amount of debt out there.
And it's important to remember that TLTW is not your average bond ETF. Those covered calls can boost income when the market's trading sideways, but they also introduce a different kind of risk that investors need to understand.
Before you jump in, think about your risk tolerance, your time horizon, your investment goals. How would TLTW fit into your portfolio? What are your expectations for the bond market in general? And are you comfortable with the potential downside if those risks we talked about actually happen?
Those are all great questions. This deep dive has given you a good starting point, but the research doesn't stop here. It's up to you to keep digging and explore these issues further. What other research would you do before making a decision about TLTW?
That's a personal question for each investor, but I'd say go beyond the headlines and look at the actual data. What factors are different today compared to the late 90s? How would those differences affect TLTW and its covered call strategy? These are the types of questions you should be asking yourself.
You've heard it here, folks. Do your research, ask the tough questions, and make informed decisions.
That's what it's all about. Informed investors are empowered investors.
Well said. And that wraps up our deep dive into TLTW. We hope this discussion has been helpful as you navigate the sometimes complex world of bond ETFs. Thanks for joining us.
Thanks for having me. It's always a pleasure to talk about this stuff.
And to our listeners, we'll catch you next time for another fascinating exploration of the financial world. Until then, happy investing.